Good morning, everyone.
Morning.
Thank you for being here. I'm Patrick Levesque, the Executive Director of the Canadian Chamber of Commerce here in Hong Kong. It's our pleasure to help organize this event. I think it's going to be very insightful. Our chamber is one of the biggest international chambers in the world, and we pride ourselves on organizing insightful events. We do about 60 of these a year. And it's really about connecting people, giving you opportunities to get access to expert opinions, insightful information, and hopefully get information about Canada, Hong Kong, and Asia, how we can facilitate opportunities, trade, investment, and commerce together. If you're not part of the chamber yet, let me demystify this. You don't have to be Canadian to join the chamber, so come see me today if you're interested. I'd like to thank RBC. They're our title sponsor for today's event.
Good morning, and thank you for joining this discussion today on demystifying tax residence by the Canadian Chamber of Commerce in Hong Kong. My name is Victor Chow, and I'm the head of Royal Bank of Canada's private banking business for the North Asia region. I first would like to begin by expressing my sincere apologies for being unable to join you today in person. RBC is delighted to be the venue sponsor to facilitate this discussion around Canadian and non-Canadian tax residencies. Today, we first will focus on understanding the concept of tax residency in relevant jurisdictions, and subsequently try to simplify some of those complexities to facilitate your income and wealth planning. RBC's wealth management business has been supporting clients and their families throughout the Asia-Pacific region for decades, particularly those that are global in nature. For those of you who are familiar with us, we are Canada's largest bank and among the largest in the world by market capitalization of close to 180 billion US dollars. And to boot, we have a AA credit rating across both Moody's and S&P, something quite unique for a bank of our size. Our footprint in Hong Kong dates back to 1969. And today, we are extremely proud to be the only Canadian bank with a full wealth management and private banking business platform in Asia. At RBC, we pride ourselves on first understanding our clients' situation, needs, and priorities before putting together solutions that may add value. Please do not hesitate to speak with any of my colleagues here today if you would like more information about us. A gentle reminder that today's discussion is general in nature. Please seek professional tax and legal advice for your specific situation. Once again, thank you to the Canadian Chamber of Commerce in Hong Kong for organizing this event. I am delighted to welcome all of you to RBC today and hope today's discussion will be rewarding and insightful, as well as delightful to you. Thank you for joining us today.
Thank you. I must also mention that as a co-sponsor, Deloitte China is also co-sponsoring this seminar, just to make sure their participation has been recognized. And so today is a very sunny and warm good morning to those who are in Hong Kong today, who are in person here. At this fabulous RBC offices, I've never been here. Didn't realize they have such great view. So the next time when we have fireworks, they should invite us. And to those who are attending this seminar virtually in Vancouver, a good afternoon, and a snowing and a very chilly, actually freezing Toronto, a good evening to you. My name is Victor Yang. I am a lawyer and a governor of the Canadian Chamber of Commerce in Hong Kong. I will be the moderator of today's seminar. This seminar, as mentioned by Victor, actually is the brainchild of Iggy Chong, who introduced himself just now. He is presently the head of Enterprises Asia, and soon to be starting a family office consulting business. And we wish him every success in his new endeavor. So if you guys have a family office with any questions, he is the go-to guy. This is going to cost you. We should also recognize a few people who work behind the scene to make this seminar possible. They are Varun and Katie from Canadian Chamber, and of course, under the guidance of Patrick, who spoke earlier. Lawrence Law and Yvonne Chick from Deloitte China also helped. As mentioned before, this seminar is meant to demystify tax residence, focusing on Canada, Hong Kong, and China. Hopefully, this seminar will provide clarification on the residency, non-tax residency for Canada, Hong Kong, and China. There'll be tax treaty discussions, and of course, a very complicated tie-breaking rule. We have today an excellent panel of speakers, and I will introduce them alphabetically. And first, Joyce Lee. That's Joyce Lee. She used to work with me in the Hong Kong law office. And now she is in Vancouver, a very well-known tax expert and a King's Counsel. Joyce's practice involves tax advice, private and public corporate tax planning, corporate reorganizations, personal and estate tax planning, domestic and offshore tax planning, advising charitable organizations, federal tax issues, voluntary disclosures, net worth assessments, and audit strategy. Her practice is focused on Canadian tax issues involving Asia-Pacific clients. Joyce was admitted to the Law Society of British Columbia in 1996. She has completed the Canadian Institute of Chartered Accountants in-depth tax course, all 3 parts. She's a regular speaker on tax-related matters. Joyce has presented on important developments in addressing Canadian tax disputes, ins and outs of doing business in China, and Canada-Hong Kong tax treaty. Joyce speaks English, Cantonese, and Mandarin. The second speaker on my extreme right is Kai-Yan Pao. She's a partner in Deloitte China's Tax and Business Advisory Services. She's based in Hong Kong, so it's easy to look for her, and focuses on providing tax and business advisory services to her clients. With over 15 years of professional experiences, Kai-Yan has a wide range of exposures in planning and implementing tax-efficient arrangements and handling tax compliance for her clients, associated corporations, as well as family and personal assets. Her focused services include tax planning and business consulting around IPOs, investment holding and financing structure, family office, there you go, another one, and tax residency status, trust setup, etc. Kai-Yan is also a frequent speaker at seminars and webinars hosted by different professional bodies, accounting and tax institutions, business chambers, etc. Last and not the least, on my right is Patrick Yip. Patrick, an experienced international tax partner, is also vice chair of Deloitte China, so he's very senior within that organization. He specializes in U.S. international taxation, China, Hong Kong cross-border taxation, and structuring M&A transactions. He also advises high net worth individuals on multi-jurisdictional trust and estate planning. In addition, he is a specialist in FATCA and CRS. Very useful expertise. Patrick worked for a Big Four accounting firm's international tax group in San Francisco, and then Deloitte's National Tax Office in Washington, D.C. He was involved in tax policy discussions with both the Hong Kong and Chinese tax authorities. He's fluent in English, Cantonese, and Mandarin. He's both a CPA, USA, and Hong Kong licensed, and an attorney at law from California. Patrick graduated with an MBA degree in taxation and a BBA degree in accounting from the University of Texas. He has an undergraduate law degree with honors from the University of Cambridge, followed by Masters of Laws degrees from both the Columbia University as a James Kent Scholar and the University of California at Berkeley. I'm running out of breath just reciting Patrick's academic accolades. Finally, he also has an MBA degree with honors from the University of Chicago. By the way, Patrick was my boss at Deloitte Legal, even though he is a C-Dai of my high school.
Yeah. We went to the same high school, but different periods.
That's why I said C-Dai. So
I never saw him in school though, you know.
he was too young. So we should now get into what we are here to talk about. Let's start with Patrick. The question is, why is it important to establish a clear tax residency?
Well, that's the reason why you're here so early, right? In the morning. Actually, yesterday, Kaya and I, we took the 8 o'clock in the morning high-speed train to Guangzhou. Again, speaking to a room about, people like around 80 to 100 people. They were all intent on listening to the same topic. It's about tax residence. I think it has always been important, but especially after the introduction of CRS. A lot of people thought CRS was just another tool, but actually it has turned out that CRS has become a very powerful weapon that has been used by tax authorities around the world to try to catch people that they thought have avoided paying taxes on income that is not within that particular jurisdiction. Just to share you with a story, about maybe a month ago, Bloomberg interviewed me and asked me about Chinese tax authorities trying to tax certain individuals on their income outside of China. So I kind of share with them about what I've seen in the marketplace. And it's all about tax residence, because a lot of Chinese individuals, they have other passports. They have other like ID cards. And they will tell China that I'm not a tax resident in China. Then take Canada as an example. They will get a tax resident in Canada. Then you ask him, so where do you live? Okay. And then he really is hard pressed to answer that question. Now, obviously, the ideal place will be Hong Kong. Okay. I'm a resident of Hong Kong. But the fact is, how can you justify that? What are the facts and circumstances that can justify that you have tax residence in Hong Kong? Now, the consequences can be very dire, okay? China may say, you are my tax resident, therefore I have to tax you on whatever, okay, 20%, 45%. And then Canada could also say, well, you are our tax resident, we will tax you on this and that. Now, fortunately, there's a tax treaty, later on we'll talk about, between China and Canada. Then some of the issues can be resolved. But you can see this is a very lively, very actual, on the ground kind of issue. So what happened was in that article, so I talked about what happened to some of these individuals who were asked to self-exempt themselves, okay, whether they have income from outside of China and all of that. So that article, so for US tax purposes, residency is not something that you need to worry about because you have to pay tax. Even if you're on the moon, you still have to pay tax, okay? However, for Canadians, for Chinese, okay, if you can claim that you're not a tax resident, I think you will be able to avoid a lot of the very high taxes and whatever on income. So that is a long way of impressing upon the audience that why tax residence is very important for this purpose. Okay.
Are you going to talk a little bit about inheritance tax implications?
Yeah, it's now obviously China doesn't have inheritance tax. okay? And
Yet.
okay? Hong Kong doesn't have one. And then some other jurisdictions in the UK, they have one, okay, which could be pretty high, 40%. By the way, recently, just 2 weeks ago, I was in London and Paris together with the Hong Kong government. So Hong Kong government said, hey, Patrick, it would be great if you could come because we'll be talking to family offices family offices in Europe to try to attract them or lure them to come to Hong Kong to set up family offices. So I ended up in Paris, right? So I was talking to these wealthy families, and something I find to be very surprising is that the way, if you are a tax resident in France, when you die, so you pass your assets to your family, and the beneficiaries will have to pay 45%. So let's say you pass $100 worth of assets to a beneficiary. That beneficiary will have to pay 45%. And you pass it on to a non-family member, 60%. So at the end of that discussion, I said to the room of participants, I said, now I know the best tax planning idea. Oh, they have a tax exemption, 100,000 euro per person. Okay, so not very much, okay? So I said, look, I think the best tax planning idea, spend it all before you die, okay? So this is the inheritance tax issue that we need to deal with. Now, if you, again, US is not an issue. We are not talking about tax residency. And I know Joy said that there may be an inheritance tax issue in Canada, a small one, okay, that she can explain later.
It's actually a deemed disposition.
A deemed disposition, something like that, right? So I think we just all have to be aware where your tax residence is very important, especially in this day and age. It's really critical right now, especially after my article was published. A lot of people were concerned that whether their CRS reporting triggered the audits in China. Okay, so I'm good.
Okay, thank you, Patrick, on that. Let's go to Joyce. Joyce, a question. What makes someone in Canada a Canadian tax resident? And maybe you can talk about Canadian tax implication differences between a tax resident versus a non-tax resident. Over to you, Joyce.
Okay, just doing a testing because I'm not sitting in the same room. Everything okay there?
Yep.
We can't see
Okay.
your
Good.
face.
Right. Supposed to be.
We can't see you, but
on
Oh.
the screen.
I
anyway.
turned on my camera. It's on. Okay. First of all, I wish I was in Hong Kong. I did get a few emails from contacts and friends saying, oh, I see the promo from Ken Sham. Are you coming to Hong Kong? I said, unfortunately not. So just picking up from what Patrick was saying, tax residency is very important for Canadian tax purposes. In fact, it is the criteria for the Canadian tax authorities to levy tax. Canada taxes Canadian tax residents on their worldwide income. So that's why determining somebody's tax residence is very important. Canada does not tax based on citizenship, not like US, and we don't use the concept of domicile. There are two ways that someone can be considered to be a Canadian tax resident. The first way is pretty simple. Basically, if somebody sojourns in Canada for at least 183 days, meaning more than 182 days, then they are deemed to be a Canadian tax resident. And the Tax Act uses the word sojourn, like not stay, not reside. So sojourn has a dictionary meaning of temporary, not meant to be permanent, something like a visitor. So somebody who sojourns in Canada, it can be separate periods, does not have to be consecutive 183 days. So let's say a visitor comes here for 2 months here, 3 months there, another 20 days there. And in one calendar year, you add up to 183 days or more. Then you are deemed to be a Canadian tax resident. And with that, you have the obligation of filing Canadian tax returns if you have income, and you need to report your worldwide income, subject to treaty relief, which we'll talk about later. So that's one way. Even if you are not deemed to be a Canadian tax resident, if you are ordinarily resident in Canada, you are still regarded as a tax resident of Canada. So what does ordinarily resident mean? This is a factual decision. There are many factors that CRA will look at, and there is a large body of case law. So the factors are not exhaustive. The authorities will look at the amount of time you spend in Canada, whether you have a permanent home, whether you have a spouse or common law partner, whether your dependents also reside with you in Canada, your work situation, do you have personal belongings in Canada, social clubs, etc. And these are called ties in Canada, and there are two separate, I guess, lists of ties that we usually look at when we provide an opinion to our clients. They are primary residential ties, and these are your dwelling place. Do you have a dwelling place that is available to you in Canada? Do you have a spouse or common law partner residing with you in Canada? And what is a common law partner? Under the Income Tax Act, if you cohabit with someone in a conjugal relationship for 1 year, that is considered to be a common law partner. And then the third significant tie is whether you have dependents with you in Canada. There's a longer list of secondary residential ties. Do you have personal property in Canada, such as furniture, clothing, cars, recreational vehicles, social ties, memberships in recreational clubs? Do you have any affiliation with a church? Economic ties in Canada, such as employment, involvement in a Canadian business, Canadian bank accounts, retirement savings funds, credit cards, investment accounts. And what is your immigration status? This is one factor. Medical insurance. Do you have Medicare in Canada? Driver's license, Canadian passport, memberships in unions, professional organizations, etc. So with those residential ties, you can determine whether someone is a tax resident. It's sometimes not a black and white decision. Sometimes it's gray area. We have helped people who plan to come to Canada to plan the time they want to become a Canadian tax resident. Some people think that you land and you have to start filing Canadian tax returns. That's not true. And I've met many clients who did this blindly, and actually they did not live here. They are not considered to be tax residents, but then they filed this Canadian tax return just on their Canadian income. And when we see these clients, it's like, how do we fix it? Do we tell the tax department that you actually were not a tax resident? It's difficult. It can cause like complications. If you are a non-tax Canadian resident, you are still taxed on Canadian source income. For example, if you have employment income in Canada, if you dispose of what we call taxable Canadian property, which we can simplify as assets that have some connections with real property in Canada or resource properties. So that's how, or rental income, that type of income, Canadian source.
Joyce, in reverse, if one wants to decouple from the Canadian tax, like what I did when I departed from Canada, I would have to do the reverse, which to give up my clubs, my social clubs, turn in my driver's license, give up my BC medical plans, and change my bank accounts to a non-resident address. So the reverse is same. It's the same. So you decouple by doing the reverse. So Joyce, is it possible for someone who is a landed immigrant or PR of Canada to not be a Canadian tax resident?
Yes, for sure. So just now I said I do advise some clients who are applying to immigrate to Canada or who have the landing papers, and they want to know what happens when they land. Will they automatically become Canadian tax resident? And the answer is no. As I just said, like the immigration status, your permanent resident status in Canada is different from Canadian tax residents, although they could be like interrelated. People who land in Canada and then they start to rent a property, buy property, establish ties, and then they don't go back to their home country and they remain here, the Canadian tax filings can start right away as a part-year resident for that landing year and then continue. But for those who are not quite ready to come here, they may land because they have an expiry date to become a landed immigrant, and then they may go back to their home country to continue to work or wind down their business, etc. In that case, if they simply come here to land, but they don't establish a lot of residential ties, the spouse and the kids go back with the applicant, and basically they don't have much presence here. Even if they start like setting up a bank account or let's say obtain a social insurance number, in those cases, if they are not here physically, I can usually tell them quite comfortably that they are still a Canadian non-tax resident. Years ago, I had a client who wanted to maintain the PR status. I'm not an immigration lawyer, but I generally think that the requirement is for a rolling 5 years, you have to spend 730 days in Canada. So if you decide to do that over 5 years equally, that is 146 days per year, which is less than the 183 days that I mentioned. So because this gentleman did not set up too many other ties in Canada, he had no permanent residence, he did start to buy some investments. And then when it came time to renew the PR card, he was able to renew it. And then this went on for almost 10 years when he did not file any Canadian tax returns in Canada. And then he retired and he sold his business. And that's when he was ready to come here. And now he moved here and it's been a number of years and he's got his Canadian citizenship. So in the right type of circumstance, it may be able to really like lengthen that time of non-residence, even though you have permanent resident status in Canada.
So Joyce, what if the applicant, normally the husband, who applied for Canadian immigration status, he has to be there and land together with the family before they qualify under the Immigration Act. The wife and the children stays behind. The children goes to school. The wife lives in Canada. But the husband goes back to China, Hong Kong, and continue his business and continue working. Is there a way that this gentleman could avoid becoming a Canadian tax resident because he is ordinarily probably a resident because his family and his children are residing in Canada?
Okay, so for a family that is coming into Canada with no previous presence in Canada, the husband, in that case, we will advise him to spend as little time in Canada as possible. Well, subject to like whether he cares about the PR, whether to maintain it, okay? But let's say he's able to not spend a lot of time here, and then the rest of the family instead will go back to visit him during holidays. In that case, the significant tie is that the wife and the kids are here. But then he was not a Canadian tax resident before, and he is not going to be deemed to be a resident because he's careful. He's not going to spend more than 182 days here. So ordinarily resident, the primary significant tie is the family, and they have a place here, obviously, either rented or purchased, that is available to him if he came, but he's not going to come. And then the secondary ties will make sure he has none or very little. In that case, we have provided an opinion saying that we think that you may be regarded as a Canadian non-tax resident. But if we are wrong, then we turn to the tiebreaker rules. So if this person is a tax resident in Hong Kong or in China under their regular tax laws, then we may be able to then rely on the treaty tiebreaker rules to say that that person tie breaks into Hong Kong or China. And Guyan and Patrick can talk a bit about what it is to be a tax resident in those jurisdictions. And I have to, you gave the example of yourself departing Canada many years ago. It is much harder to become a non-resident when you are already a Canadian tax resident for a long time. We didn't used to have a treaty with Hong Kong. So at that time, when people leave or want to leave Canada, we advise them to cut as many ties as possible. If you have a house, you either sell it or you rent it to a third party. Like Victor said, stop your golf club membership, don't be employed anymore, cut all the ties. Now that we have a treaty, it's better. But in general, it's much harder to leave Canada than to come here. So in the example you gave, it's possible for the husband to remain a Canadian non-tax resident.
I've also experienced the spouse after landing not apply for medical coverage, not to apply for a driver's license, and basically do nothing and just leave. So that would make the case even stronger. So I think we've touched enough on that. Let me go back to Patrick again. How does one not become a China tax resident? We talked about not being a Canadian tax resident. What about China?
Okay. In a certain sense, China is somewhat like the US, is that once you still have a China hukou, meaning household registration, that will enable you to have a China passport. If you hold on to that, you are considered as a China tax resident no matter where you go. However, what is not the same as the US is that if you could, even if you're a China passport citizen, if you can claim based on treaty that you're actually a tax resident of another jurisdiction, such as Hong Kong, then for treaty purposes, even though you still have the China household registration, you can be considered as a Hong Kong tax resident. Now, this is very critical, okay? And which Guyan will talk about how to determine whether the treaty would actually apply to make you a Hong Kong tax resident versus a China tax resident. The reason why this is so critical is because imagine you are a senior executive of a, let's say a SOE, a state-owned enterprise in China. Then you are seconded to Hong Kong to work in Hong Kong. So you're very excited, very happy, not only because the tax rate is low in Hong Kong, because you're away from your family. So, so you're all by yourself in Hong Kong, and then you pay 15% salaries tax. Hong Kong is great. We only tax you on salaries tax. Salaries. We don't tax you on dividends. We don't tax you on interest and things like that. So while he's very happy, then he comes to a seminar like this. And then I'm talking about tax residents and all that. I said, hey, by the way, if you're still a China tax resident, the 15% that you pay in Hong Kong is not the end of the story. because you still have to go back to China and report your Hong Kong income to the Chinese tax authorities and pay 45%. And then use the 15% as a foreign tax credit to offset against that 45. So in essence, you pay 30% in the excess. On top of that, 15%. Now, of course, sitting in the audience, you will be very unhappy, right, to hear this. So your only salvation is that you can somehow argue that you are not a China tax resident because of the treaty. But I can tell you, it's very hard for you based on your fact pattern, because you are the only guy of your family that is in Hong Kong. Okay, so Kayan will talk about the details of the rules, right? Yeah.
Okay, before we get into the resolving on the tax residency issues between the three jurisdictions, why don't we go to Cayenne on the Hong Kong side?
Yeah.
And then we'll do some case studies
Yeah, sure.
after
sure.
that, okay? So it sounds like there are obvious tax advantages for someone to establish a clear and sole tax residency in Hong Kong. So how does one become a Hong Kong tax resident or prove that she is a Hong Kong tax resident?
Yeah, sure. So obviously, it's lovely to be a Hong Kong tax resident, right? And somewhat like the U.S., Hong Kong does not tax you based on your tax residency. So rather, it would be the external factors you want to prove to the Canada side. You want to prove to the China tax authority that you are a Hong Kong tax resident. So this is a very interesting case for Hong Kong, the definition of tax residency is very straightforward. You can either be a temporary tax resident or ordinary tax resident. If you are a temporary tax resident, straightforward, we only look at the days. If you stay for more than 183 days in a tax year, in Hong Kong, we start from 1st of April to next year, end of March, or you stay for more than 300 days in Hong Kong for two consecutive tax years, you would be a temporary tax resident. If you do not meet the day rules, then you can prove yourself to be an ordinary tax resident, where you look at, do you have a permanent place here? Is your family here? Your wife, your husband, where do your kids go to school? So very straightforward for Hong Kong. And it's very interesting to see, just for the case study here, you can see the definition of tax resident. There are three sets. Hong Kong, you look at, straightforward rules, the days, your family. China, you look at whether you still hold the China passport. And in Canada, maybe it considers more on the ties, the economic ties, and the club membership, and etc. And, in the case study, it's a very real case where, one individual or one family could have, trio residency. And in the past, if there is no tax treaty between these three places, it could be very troublesome. But nowadays, the good news is Canada has tax treaty with Hong Kong. Similarly, Canada has tax treaty with mainland China as well. So in that case, we could look at the tiebreaker rules here to determine where you have a more stronger ties. And later on, we'll also talk about how can you strengthen your Hong Kong ties with the setup of a family office in Hong Kong as well. But first of all, we will go through these tiebreaker rules first. So according the tax treaty between Hong Kong and Canada, and between China and Canada, are very similar. We look at these factors in sequence. First of all, we look at where is your permanent residence, and then we look at your ties, and then we look at your habitual residence. But a lot of time for a family, you could have both, right? I can have in the case study, family, the wife has a house in Canada and the husband has a place in Hong Kong as well. And they have both, some ties in both places. And it could be arguably that, they have habitual residence in both places. And in that case, in the very, very, very extreme case, the two authorities will have to do a mutual agreement. And that would be a very not ideal case, because in that case, all the family's worldwide assets, worldwide ties would have to be put on the table, very transparent to both of the tax authorities to make a determination mutually. Yeah.
Kayan, to really strengthen one's ability to claim Hong Kong as its tax residency, what about a tax certificate issued by the Hong Kong tax authorities? And is it available? How difficult is it to get one, and the procedures?
Yeah, so we talked about the definition for Hong Kong. It's very clear, very straightforward. Similarly, for the procedure, you can definitely apply for one. But as we said before, Hong Kong does not tax you based on your tax residency. So really, the Hong Kong Inland Revenue does not have the motive to issue a tax certificate to an individual unless there is any clear what we call a treaty needs. So one can apply to the Hong Kong Inland Revenue if there is you really need this certificate issued by the Hong Kong ILD in order to claim the tax treaty benefits with Canadian tax authority, Chinese tax authority. Only in that case, the Hong Kong ILD would consider to issue a tax resident certificate to you. And in the application, the information to be submitted are also very factual and straightforward. Your travel record in and out of Hong Kong. Where do your family live? So lesser, non-factual information to be considered. So it's quite friendly for the Hong Kong application environment and regime.
I just want to add a couple of comments here. The reason for the fact that you need to show to the tax authorities that you really have a need in order that they would give you a tax residence certificate is because they don't want you to say, because Victor always invited me to the Hong Kong Club for lunch. They don't want you to just show off, I'm a club member, okay? So then you can show off to whoever, I'm a Hong Kong tax resident, just like a Hong Kong club member. They don't want you to do that. They really want you to use it only when you're being challenged by another tax authority, right? And secondly, I would like to refer to the first, when Kayan said this in sequence, that means if you win on the first factor, then you're done. You don't need to go down the list. So that means the first factor is most important. So later on, Joyce will also chime in. I can explain to you why this can be very difficult, okay? So there are two words, right? Permanent and residence, or resident can be home, right? So let me give you an example. Let's say the whole family, they move to Vancouver. So they find a palatial home in Vancouver West, Puget Drive, with a panoramic view of the sound or whatever, okay? So it's so beautiful, a few $1 million, right? Canadian dollars, so it's a huge place. Then the husband moves back to Hong Kong, and he goes to Sam Sui Po, and he rents a very small, dingy apartment. Because what he hopes to do is just to make a lot of money in Hong Kong to support the family in Vancouver. So he's a cheap guy, okay? He just wants to have a small place. Then the question is, obviously, he has both homes available to him on a permanent basis. There's a lot of argument as to whether the Sam Sui Po home can actually be treated as a home for this purpose. Because he's just using that like a sojourner, like using the term in Canada, right? So if I were the Canadian authorities, fortunately I'm not, okay? I know the Canadian rules are a bit, I think Joyce would probably explain that a little bit more later, is that maybe they will just look at whether that place is available to him on a permanent basis whenever he wants it. But from a China and Hong Kong perspective, they would, first of all, they will probably argue or challenge you whether this is a home to begin with. Okay? If it's not even a home, let's not talk about whether it's permanent or not. It's not even a home. It's just a place. Now, the Hong Kong and China argument, I think, has some logic to it. If it is not a home, it's just a place for you to live, to stay in, why would there be habitual abode later on in the test? Right? What is the difference between a home and an abode? So I think China and Hong Kong will try to argue, based on the treaty, that if it's simply a some sort of place, in my example, they may not agree that is your home. Okay, even though it could be permanent. So then they would say, China, Beijing, well, in my example, China, Hong Kong and China tax arrangement. So they would say the place in China is really the home. The some sort of place in Hong Kong is not your home. Okay, so that would be difficult. Now, another scenario. So you have a home in Hong Kong, so where your children grew up and all of that. And then you move to Vancouver and you bought this palatial home in Vancouver West, but you still keep your home in Hong Kong. And then when your family, they come back to Hong Kong, they will live in the same home. Then I will have a better argument. Okay, in both places, of course, I'm not a Canadian tax expert. I'm just going to leave it to Joyce. But I'm thinking that at least in a Hong Kong and China perspective, then at least I'll be on par. I would say both in Hong Kong and Beijing, I have a home. And that is permanent. And then I can go to the second factor.
Patrick, you need to link him also to China. So the guy has a job in China, probably.
Yeah.
Okay,
Right.
so he has his family in Vancouver, kids going to school and everything. He has a some triple apartment.
Yeah.
And then he must be working in China.
Yeah, that's right.
Otherwise, China wouldn't be in the play.
Yeah, exactly. So,
Yeah, so it's
again, you need to
three
three
jurisdictions.
jurisdictions. Yeah. So again, I mean, maybe an easier way to at least get rid of one jurisdiction, Canada, is to get a technical divorce with your wife. Yeah, amen. And then you say, hey, that's not
Very
my
tricky,
home
huh?
anymore, right? That's not my home anymore. Because I don't have any relationship with that woman. And now I'm just living here. And then to even enhance your case, you find another, I mean, you find a so-called second family in China, right? And then that will make your, no, in Hong
That's
Kong.
your
I mean,
case.
actually, no, not my case. Okay, now it's getting complicated. You know how complicated it can be, but I'm just trying to illustrate the point that in applying the tiebreaker rules, it's not as easy as it meets the eye. Okay, there's more to it than you think. So I think maybe George, you should chime in now because I think Canada has a slightly more straightforward view of how the permanent home should be defined, right?
Yes. So normally, if we have to resort to the tiebreaker rules, the first one is the availability of a permanent residence. And how we explain it here is you don't have to own it, but it has to be available to you. So if your wife is the owner of a house in Vancouver, your name is not on it, but then obviously when you come to Canada for visits, you can stay at that home. So that satisfies the permanent residence in Canada. But then when this husband goes back to Hong Kong, he has a place to stay, which is available to him long-term. It could be a long-term rental, or it could be a house that he already owned. Then it will satisfy the permanent residence factor. Going back to the example that Patrick gave, if I can see the point. If it was a case where the family was already settled in Canada, and then the husband, after a few years, decided that, okay, now the family is settled, the kids are older, I want to go back to Asia to pursue business opportunities. So he's leaving. And then he doesn't know if this is going to be successful. And because they left for many years, he no longer had a permanent residence. And now he's renting this teeny place in Hong Kong that even the wife and kids cannot stay at if they were to visit him, because they will stay in a hotel or with relatives. And in the meantime, the husband is like going to China, like staying in Hong Kong. Like, I think in that case, the tax authorities may have more argument. For example, Canada could say, like, have you even left Canada, right? But if they came from there and he's settling there, I think for us, I do believe that that test is easily satisfied if you have a permanent place to reside at.
Patrick, using your case study just now, family in Canada, the husband has a place in Sam Shui Po, and he works in China. Now, there's different scenarios as to where they gather during holidays. If they have a holiday, all the family gather together in Canada, or they have all their holidays in Hong Kong, or they go to China for holidays. Are there differences with respect to the tax residency?
Maybe Kai can talk about Hong Kong and China, huh?
Yeah, definitely. It turns out holiday, where do the family reunion during a holiday is also important. In the example we are talking about, if there are permanent residents available in both places, because the family have to temporarily live apart due to education reason or whatever reason, then in that case where is we look at the ties and we look at where is the habitual residence. And obviously, where do the family reunion during the holiday would be a major factor to determine, between the two places, where is the place where, is their habitual residence.
Yeah, but it's only when you have to get to number 3. Okay, so if your issue is resolved at number 2, okay, then you don't need to go down to number 3, right? Plus, Victor, the case won't want to be in Hong Kong or China. They want to be in Japan. Okay, so this trick question doesn't work. Okay, now and in terms of the second one, right? So talking about the center of vital interest. So usually it's the place of employment. Okay, and then, but again, it also talks about personal. So it could be like what Joyce mentioned about the secondary ties, all these things. And so usually we would have to try to win the case in the first factor, the permanent home factor. I think that is actually more straightforward, easier to argue. But as you can see, there are cases that are really difficult. It's hard to decide. So you need a bit better planning ahead of, let's say you want to move back to Canada, or especially I like to quote a case where if you send your kids to UBC and then you claim you're a local resident and pay only very small fees, okay? So then you are inviting really the tax authorities to look at you and to see whether you're really a tax resident in Vancouver, right? Because in Canada, because you live in such a nice place and then you're not paying much fees, you're claiming you're a local resident, where do you get your income from? And it turns out your husband is working in Hong Kong and China. And then the husband hardly comes to, it comes to Canada quite a bit to see the family. So all these things will come into play. And it's quite significant, right? I mean, whether you pay local student fees and versus a foreign student fees is quite significant. You can say, hey, I don't claim medical coverage and whatever, but when it comes to actually paying out the fees, is really a difference. And this is where I think the issue may come up. The Canadian tax authority will be more interested in you. And similarly in Hong Kong, it's the same way, right? Especially, think about it, right? If you are a Chinese individuals and all of your offshore income in Hong Kong, in Canada, will be subject to tax in China if you're a Chinese tax resident. But if you can say, I'm not Chinese tax resident, I'm just Hong Kong, then all of a sudden, only China source income is taxable, which will make a very big difference. And that's why you see when Hong Kong opens up its immigration programs, so many people apply, okay? And the reason is not that they really like to live in Hong Kong, is that they really want to get the Hong Kong tax residence, which in 7 years will get them permanent residency, and then they can give up their household registration in China. Then they will be, for sure, be considered as a Hong Kong tax resident, even though they may be spending a lot of time in China. You know, as a Hong Kong person, you can spend 6 years in China as long as you have one period that you're away from China for 30 days consecutively. So that's why, like Deloitte, we send a lot of people to our different China offices. They even get married, they buy houses, you know, in China. They still claim themselves as non-tax resident of China. Okay, even though they live there. The reason is that every 6 years, they will leave China for a consecutive 30 days. So you see, it's really, Hong Kong is the best of both worlds. You can be a Hong Kong tax resident.
John Lee loves him.
Yeah, and then you can continue to work in China. But you claim that you're a non-resident working in China. Of course, you have to pay tax in China on your earnings and everything. But all the investment income that you have outside of China will not be taxable. So that's why, just like you get your passport in Canada, then you make money here in Hong Kong as a non-resident of Canada, and you pay very little tax. And that's the same kind of game, right?
Well, because of all the uncertainties, Joyce, I know in Canada they have advanced ruling, advanced determination, even though it's non-binding. Could you explain or elaborate a little bit more on that procedure? And I don't know whether they have similar advanced rulings from IRD or the China STA. Joyce, would you talk about the Canadian side?
There is indeed a form and a process that an individual can go through to ask CRA to determine whether they are a Canadian tax resident. This may be helpful when somebody leaves Canada. They want to make absolutely sure that they are considered to be a non-tax resident. They will fill out this form. It's called the NR 73, and it asks a lot of questions. For example, like the ties questions, factors that I mentioned just now. Do you have a home here? Like, where are your dependents and your spouse? And then you check the box here and there, yes, no, and then you write it in. And then CRA will review the form and the responses, and they will come back with a letter saying that based on the information that you have provided, we regard you, we believe that you are a tax resident or a non-tax resident of Canada. We as tax lawyers would not advise our clients to go through that procedure and fill out the form. We know what the criteria are, what the factors are. If you tell us the same facts, we can, give you an idea, an opinion as to what we think. The advantage of getting that determination is if you get a favorable letter, then you can keep it in your file. Oh, I'm a non-tax resident. But then in some cases, maybe it's gray area. Maybe you keep some ties in Canada. They may come back and say, no, based on these factors, we think that you're still a Canadian tax resident. So then this decision is non-binding. Of course, if you get a good letter, you're happy and you keep it. But if you get an unfavorable letter, it's not binding. So what's the purpose? Just try your best, be a non-resident if that's what you want to be. And I don't think it's necessary to obtain that determination.
For Hong Kong, unlike Canada, there is no advanced ruling mechanism on tax residency, but rather, oftentimes when we work with the overseas office, say, for example, Canada, France, UK, in determining, exiting the tax residency there as soon as possible, the question to us would be how fast can the IRD ground confirm you as a Hong Kong tax resident? And it's quite quick. in the fastest way. Have you, as soon as you move to Hong Kong and stays here for 183 days, and already in that tax year, the Hong Kong IRD can already confirm that you are a Hong Kong tax resident by issuing the certificate. And in most of the case, it would be helpful, to get that certificate to the Canada Tax Authority, China Tax Authority, and other tax authority to help with the tax residency exit in that jurisdiction.
Now,
sorry.
let's talk about China, okay? Now, first of all, China, again, we don't have this mechanism, formal mechanism, and it will only arise when a tax treaty situation, a tax breaker, tax tiebreaker situation, that China will need to determine whether you are a resident or not of China. Now, even if, just like what Joyce said, even if China had this kind of mechanism, or you just want to be sure, you just go talk to you wanted to talk to the tax authorities in charge of your file to get an understanding, my advice to you, don't do it. Okay? Because I know the answer will be, yes, you are. Without even looking at your file, they will say you are, because you know what? They need revenue. So my Chinese clients, my Chinese even tax officials, they tell me, yeah, these are the rules, but there are also 3 Chinese words that you need to remember. 不讲理. Okay, meaning that they don't talk reason. Okay, so if they need to, they really, if you really come to them and say, hey, am I a tax resident? Then I think after you have left, they will all burst out laughing. How can this person be so stupid by coming in and ask us, whether he's a tax resident or not?
So Joyce,
sure
you have an experience about tax certificate in China, right?
Well, in that case, because my client was under audit, she wanted to say that she was a non-tax resident. So I asked her, can you go to your tax authorities in China and get me that tax certificate? And she got it.
Yeah, because in that case, because it's in an audit, right? So the issue became relevant. Then you really have to get it. Yeah, and China will be very happy to give you that certificate because they will be taxing you, right? Yeah.
Do we still have a few minutes? There's one question I thought a lot of people might want to ask is returning to Canada. If there are, it's not in what we were about to disclose today, but it's not in there. But I think this is something that might be of interest to some people returning to Canada. And maybe Joyce, if you could just summarize some key points for them, how they do some planning prior to returning to Canada.
Okay. One of the things that I do a lot of pre-immigration consultation, and in that consultation, I will ask the clients for their general assets, like what type of assets do they have, who owns it, in whose name. In Canada, we have these rules called attribution rules. Let's say Victor comes back and he came back with $1 million in his name. So he's going to invest that money and he is going to earn returns and he is going to be taxed on that return in his own name. Because we have a graduated tax system in Canada, the more you earn, the more tax you pay. And right now in BC, the combined federal and BC income tax rate, the highest tax rate is over 53%. So then if you come back and you talk to the accountant and the accountant said, oh, if you put $500,000 in your wife's name and you also have $500,000 in your own name, then whatever return, you will be taxed separately. But these attribution rules will attribute everything back to Victor. So one very simple way is before you come, is that important to you? This graduated rate, how much income do you anticipate to have? Maybe when you come in, you already should put this money into the bank account jointly. Because whatever you do in Hong Kong, it doesn't matter. You can give the money to your wife. like outside Canada, you bring it in together. You may have owned it long time ago, right? But once you come, you can have a joint account, or she can have her own money, you can have your own money, and then you start like your tax filings that way. And if people have offshore trust that is set up for their benefit, we would definitely suggest analyzing that trust to see if our non-resident trust rules would deem that trust to become a Canadian trust once they come to Canada. If they have special like income or like employment like plans, for example, stock options, may be best to like wind those up before they come. Otherwise, like the whole thing could be regarded as income rather than just the gain part. And then I always advise them to do a valuation, because when they come into Canada, they are deemed to have disposed of their capital assets, and whatever the current fair market value will become their new cost base for Canadian tax basis. So if they do the valuation close to the day that they come, then that will be their cost base for future Canadian tax purposes. Some people may want to come here, obtain Canadian citizenship ASAP, and then maybe go back to their home country. In that case, it's possible to get your citizenship within 5 years. There's something called departure tax in Canada. If you come in owning these assets and then you leave within 60 months, there's no departure tax on the pre-existing assets. So if that's your plan, like, you can also plan around like the 60 months, like, get the status, have the safety, and then, go do your business, etc. So these are some of the points that I would mention in those pre-immigration consultation. Oh, one very relevant issue that I'm often asked about, it seems that in Hong Kong, insurance policies are very popular as like a savings mechanism. I'm often asked if the client comes in with these like Hong Kong insurance policies with a savings component, is that taxable? Is that reportable as foreign asset? Without looking at the policy, without doing some analysis, I don't have an answer. So if people plan to enter into those policies right before coming, I usually tell them, don't do it. We have those similar policies here. You can buy it as a Canadian policy. But if they have a pre-existing long-term one, the consideration is, do we collapse it or do we keep going with it? So that's one of the relevant tax issues that I'm asked about.
I know there will be questions, but Cayenne has one point that she wants to talk about before we get into the Q&A.
Yeah, can we go to the next slide, please? Next. Yeah. So I wanted to talk about Hong Kong family offices as well, because this is a lot of our clients are currently doing now. So in the past discussion, you can see oftentimes the tax residency of the individual family members may be not entirely clear. There may be still some risk that the Canadian tax authority, the Chinese tax authority still has a chance to consider you as a tax resident. So in that case, you would not want to, brutally expose the individual to, all the investment gains. And some of the tools that our client would use would be a SPV to do the investment, usually an SPV in BVI, Cayman Island. And additionally, you can either do it with or without a trust. So those are the common tools. Using these kind of BVI companies in the past might work, but no longer work nowadays. So that's why the Hong Kong IRD, the Hong Kong government, is trying to offer a formal tax concession to these kind of BVI SPV if the family sets up a family office in Hong Kong. So in brief, if one family sets up a family office in Hong Kong, employ 2 full-time employees in Hong Kong, they could be family members. The family office spends, at least 2 million Hong Kong dollar a year in Hong Kong. It could be rental, it could be salaries to the family members. And this family office would then, manage at least 30 million US dollar asset of the family for them. Then the SPV, what we call FIHV here, it could be BVI company, it could be a trust, it could be Hong Kong company, would get Hong Kong profits tax exemption in full. So even you do not have to pay any tax in BVI and you do not have to pay any tax in Hong Kong for the 16.5 Hong Kong profits tax. What we would like to draw attention is, for the AUM, 30 million US dollar AUM for this family office, it does not have to be Hong Kong asset and it does not have to be financial asset. So you can include your operating group or all your worldwide asset into here and just delegate all your assets for the Hong Kong family office to manage. Then you can officially enjoy this tax exemption. So what's good here is if you got this structure, tax-free at the FIHV level, tax-free at the trust level. And this is also some of what we call economic ties, which would help, the family to have a more stronger case to be a Hong Kong tax resident. Because, with this structure, if the ultimate owner are still, Chinese tax resident, Canadian tax resident, then it won't work. We give you a tax exemption here, but then you may have to pay the top-up tax at the individual level. So ultimately, if we have this structure that helps to strengthen the tax residency of the individual family members as well, then, it could be a very tax-efficient structure where no top-up tax at the individual level either.
Now, just one proviso, Chinese tax resident will still work if you interpose a trust in between the Chinese tax resident and the family office. Because right now, under Chinese tax law, the trust, offshore trust, is still considered as a separate entity from the individual. They have very elaborate rules in terms of looking through the trust and tax the individual still, in terms of the income from within the trust. So I think for China tax purposes, a family trust will still work. But just to echo Kai-Yen's point is that to have a family office in Hong Kong will strengthen your ties to Hong Kong for tiebreaker rule purposes.
Well, we're close to the end, and maybe you have questions. Yes.
Topic, but one question I have is about maintaining tax residency in Hong Kong after retirement. So as a Canadian who's worked in Hong Kong their whole career, has some ties to Canada, but is permanent resident in Hong Kong, pays taxes here, what happens after retirement if you want to spend more time in Canada? What are the rules around maintaining Hong Kong tax residency?
Presumably, I think you already have the PR status in Hong Kong, right? So we won't take that away from you. Okay, so it's just a matter of how you can avoid being treated as a Canadian tax resident, right? So I think it will be Joyce, maybe you can answer that question.
I couldn't really hear that question. Can Victor repeat that, please?
Basically, the question is if she has been living in Hong Kong for a long time and has the PR status and is about to retire or has retired, but wishes to spend more time in Canada, with Hong Kong takes away the tax residency criteria or whatever, but it's really how much time she spends in Canada, her ties in Canada. I guess that would be your answer, right?
Yeah, the PR status is in Hong Kong.
Yep.
Yeah.
But Canadian citizen.
Yeah.
And the person is already a Canadian.
Yes.
But a non-tax resident for many years. So Canadian citizen can come back to Canada anytime. If the person wants to still be a non-tax resident, you can definitely plan into that while you're still healthy, can still travel between the two countries. But there will be one day when you have to make a decision.
Yeah, I understand that. I guess my question was, I had been told, and I don't know if this is true, that in order to, it's not just how many days you spend in Canada. So you may spend less than 180
Mhm.
days a year in Canada, but that you also have to spend a certain number of days in Hong Kong in order to qualify for tax residency in Hong Kong. Is that correct?
For Hong Kong still, we go back to, at least 183 days a year or 300 days for 2 years, or either you have you have your family and a permanent home here. So it could be quite flexible.
So if you have a property here, but you spend only 4 months a year here, that would still qualify you as a PR
Yeah,
to have tax residency here.
yeah, for Hong Kong.
Thank you.
Yeah, imagine, think about it, in the case where, let's say you work for an investment bank, you live in Hong Kong, but you travel extensively in China, we'll still consider this person as ordinarily resident in Hong Kong. Okay, because it's because of his job, he has to travel everywhere. So I think in your case, if you're home base in Hong Kong, Hong Kong will consider you as ordinary resident here in Hong Kong. It's just a matter of planning your Canadian trips to make sure that you won't be considered as a Canadian tax resident. Yeah, that's right. Yeah. And then to see whether you have any other ties or whatever, So the next trip is go to Vancouver to meet with Joyce.
Yes.
Hi, I'm Jonathan. I'm a Canadian, a non-resident of Canada. So my kids.
Jonathan, are you sure? I'm
Oh,
just
wow.
kidding.
Okay. My kids are growing up, so I'm planning to send them back for college or university education. So in that case, I think Patrick touched a little bit on this topic. So how can I, or what's the best option that I should arrange my tax planning in that case?
Maybe
Huh?
Joyce?
Joyce.
Are you only sending the kids back? Are you coming?
The plan is to send the kids over there. I'm stay here in Hong Kong to work. Yeah.
Okay, so that's a pretty good, factual situation. If you come to BC, the age of majority is 19. So let's say they are 19, you can say they're not your dependents, they're adults. Of course, you still support them, financially. But I think they're just students studying here. It's a good case that does not drag you into the Canadian tax net. And I assume you are not going to spend 183 days or more here.
Right.
Joyce, can they pay local fees? I mean, that's the key.
But they have their own Canadian tax status. They are Canadian citizens. I mean, I don't know
Right.
how the school tuition, I don't know how university tuition works. They probably need to be here for a period of time before they qualify for the local fees, right?
PR and citizenship,
Well, they're holding Canadian passports. So.
they'll be considered local.
Okay.
Mm.
Wow, the Canadian government is very generous. Or the universities.
Yeah, US is not like that, right?
Yeah, the US is just like what you described, you have to be there for a year before you can pay local.
States.
Yeah, the states.
Tax
Yeah,
before
that's
we
right.
get special.
Yeah.
Any other questions? Yes.
The earlier scenario, but how about if the kids are staying in an apartment and the name is in the father's name? In that case, will that strengthen the Canadian authorities to consider the father as a tax resident?
Yeah, possibly. Possibly. I mean, non-residents can purchase properties here for investment purposes, right? So this case is better than if you were leaving and then you were still buying more properties. Like you have been away for a long time and you buy a condo or you buy a house. That's just one time and your kids are now adult. But in Canada, especially BC and Ontario, you have to think about these other non-income tax consequences. We have something called empty home tax in Vancouver. You can allow your kids to stay there and avoid the empty home tax, but we also have BC speculation tax. And if your income is not taxed in Canada, in BC, even though your kids may be staying there, you still have to pay speculation tax. So need to be very careful when you think you're buying like properties for your kids.
Hey.
You can put the property in the kids' names and it would be okay.
Yeah, Joyce, no,
yeah.
in that case, would it be better if the father charges these kids rent? So that the father can say, well, this is just an investment. And then the tenants happen to be my kids and they're adults.
Okay. Under the Speculation and Vacancy Tax Act, there's something called arm's length tenant, which is completely fine, or non-arm's length tenant.
Right. But I'm talking about like to lessen the ties to Canada. So this is just a rental property. It's not like a vacation home that my kids live in.
Oh yeah, you can do that. But what I'm saying is the place may be, or the father may be subject to this special like speculation tax because he's allowing the kids to stay there. It's nothing to do with income
Okay.
tax. Yeah.
So actually charging them rent, I think would be good. Yeah. And at least you can still have some leverage on them. Right? So they still come to have yeah, no, that's fine. That's fine. Yeah, that's the price you need to pay, right? At least they would still come to you for lunch and dinner, buy you gifts, you know. You have some leverage on them. Otherwise, they will never see you. Yeah, exactly. Yeah. They need to be financially independent. Yeah, I have many wealthy clients. They said that they really wanted to give their assets to their kids so that they can start managing them. But there's another concern is that once they have given them these assets, they will never come see them again. So that's why.
Any other questions? We are getting to 10:30 and.
Yeah, so I know it's sometimes hard to ask these questions in a big crowd like this, you know. And I have a lot of clients that will say, hey, you know, my friend's friend had this situation. There's no need to do that. Then you can just send individual questions to us and to Joyce. Okay, we'll try to answer them to the extent we can. Yeah, as you know, yeah. Yeah. Joyce, are you okay with the
No, it's
PowerPoint?
just get a PowerPoint email to the people who attend. So like, because from this side,
Yeah.
it's a bit harder to see that.
Yeah.
Well, you guys were taking pictures of the family office.
Yeah.
I'm sure
As long as
your email-
you don't hold us responsible for the correctness of the contents, that will be fine. Yeah.
I think RBC and Can Chan has got contacts of everyone, right?
Thank you all so much for being here. Just like a moment to thank our wonderful panelists. Thank you so much, Joyce, for joining in.